Welcome to Go Bank Yourself, where we break down how to grow and control capital like a banker. I'm your host, Dovi Herman, joined by my co-host, Pinny Levy. Let's begin. Hello, everyone, and welcome back to Go Bank Yourself. We are demystifying some money myths and speaking harsh truths. Today, we had the idea to talk about one of the most famous or infamous financial entertainers. And we say entertainers because he's not much of an educator. He thinks he is. He might think he is. Many people probably think he is. But it's a lot more on the entertainment side. Of course, we are talking about the one and only David Ramsey.
Dave Ramsey.
About 7 years ago, when I first got licensed, and I knew I was joining the financial services industry, I didn't know too much about it, and I wanted to make sure that I wasn't going to be leading people astray. I wanted to actually get educated in finance, and I listened to a lot of Dave Ramsey, not necessarily thinking everything he was saying was right, but it was entertaining for sure. I did like his style, and I didn't know what was right and what wasn't. I didn't have so much of a dog in the fight. I was really just trying to hear all sides of everything, all things finance, and Dave Ramsey has a huge channel. So I dove deep. I don't listen to him much anymore, but I doubt his positions have really changed.
Now, we theorized once, even if you wanted to change, what are you going to do to your brand if after, 20 years plus, you now are changing your tune? Obviously, we're talking about his stance on whole life insurance. And in particular, this is going to be a clip where he's bashing infinite banking. And like we discussed, it's really the definitions, the baseline definitions of the terms he's using that he's getting wrong. So how do you go and change your spots?
We'll get there, Pinny. We'll get there. And yes, part of what we're talking about is stance is on infinite banking, but I want to talk about a lot of his different stances. I want us to look at the full picture of Dave Ramsey, because it's not like everything he says is absolute trash. There's a reason he built such a big brand. He sticks to his principles. Some of what he says is pretty accurate. And then a lot of the way he advises people can be misleading.
So just to note, the thing I agree the most with him, the thing of his upon which I agree the most is the discipline to pay off debt and stay out of debt. The discipline of your monthly budget is very important. Now, we're going to veer off and disagree on, well, what about debt from one's own bank or one's own life insurance cash value? So that's a totally different animal, especially when we're comparing that to people who would go into debt anyway. In Nelson Nash's larger analysis of, well, saving up in a savings account and liquidating your account to buy things is eliminating your ability to earn interest in the future. So I'm paying cash, but in a way that has the negative long-term effects of having to pay interest to somebody else's bank. So since I mentioned it, I had to distinguish between the two. But his discipline on a monthly budget above all else is bar none terrific.
You brought up a comparison between Dave Ramsey and Nelson Nash, and it's really interesting. They share a lot of history, and just to remind everybody, Nelson Nash, the author of Becoming Your Own Banker, he and Dave Ramsey have a similar story that got them to where they are and where they believe, well, where the late Nelson Nash believed, and what they believed and promoted. They were both blindsided in the 1980s when they had massive real estate portfolios, and the jump in interest rates skyrocketed their note payments. And what that means is that at the time, many deals were done on 90-day notes, so the payments on their mortgages would renew every 90 days at the current interest rates. Well, interest rates rose and their payments doubled or more, and that's when they came to similar conclusions. Avoid doing business with banks. Dave Ramsey went bankrupt twice and said avoid all debt at all costs. Nelson realized that he had cash value built up in multiple whole life policies and could get to money at 8% instead of paying 23%, because that's where the interest rates went on his notes. He then realized that rather than avoiding debt at all costs, he could control the banking function and basically own his own debt.
That's fascinating. I hadn't even heard that about Dave Ramsey. I vaguely remember stories of real estate investment bankruptcy, but that's a great comparison. One said nothing more with banks, Dave Ramsey. One said, wow, it'd be great to be the bank. Nelson Nash, of course.
Exactly. So the good about Dave Ramsey, first, spend less than you make. You have to be disciplined in your spending, especially in our world where it's really, really easy to spend money. Advertising is everywhere. In the grocery stores, all these things are in pretty little packages, and it's easy to just pick it up, throw it in the cart, and not think about it. When you're going to any kind of store, it's so easy to just overspend. We don't really think about it, and then at the end of the month, you're like, how did I spend this much this month?
In our circles, of course, private school, religious family celebrations, bar mitzvah, bas mitzvah, weddings. People, the problem is keeping up with the Joneses. We've made bar mitzvahs for $4,000. We've made them for $6,000, and you wonder, what's the difference? Oh yeah, because everyone wanted this or that type of catering, and all the friends did it. And if you give in, you might find yourself keeping up with the Joneses to your own detriment. So his discipline in spending is excellent. It's a great message.
Yes, and another good message is to have an emergency fund. Now, Dave's said the emergency fund for the last 30 years should be $1,000. So it's interesting that he's just stuck to that $1,000 number when 20 years ago, $1,000 went way further than it goes today. But still, $1,000 in cash somewhere or in a bank account, fine, just in case of emergencies. And then probably his biggest thing that I would say is good, but he goes a little too far with it, is get out of debt. For me, this mostly means consumer debt. The number one priority should always be credit cards.
Mm-hmm.
Credit cards can be an endless pit. Personal loans are not a good deal, but once you're about halfway through the schedule, paying off your personal loans early, I don't see to be so impactful, at least from the numbers that I've looked at. But of course, if you can, then go for it. But to me, credit card consumer debt is the worst of the worst. There's never a good reason to go into. But when he says get out of debt, he's talking all debt. Mortgage debt. Business owners shouldn't go into any type of debt for any reason.
You could call it extremism in that point.
Yeah, so that's kind of a good and a bad. The get out of debt makes sense when it comes from a consumer debt standpoint, but of course if you understand how to use interest rates in your favor, then going into debt for a better payoff can and does make a lot of sense for a lot of people. Okay, so that's what I had as the good. Here's what I'll say is the bad. Now, my first instance is, I would say I'm more neutral on this one, but I'll put it in bad, his position on credit cards. And why I say it's the bad is just his hard stance saying, never ever get a credit card, cut up all your cards, no one should ever have one for any reason. Now for me, this is more neutral because I actually agree with him in most cases, I'd say. It's undeniable that credit cards are a net negative to society. Mm-hmm. They are a wealth transfer from the desperate and or irresponsible to people of means. What that means is that those who don't pay off their balance every month or even their minimum payments will get charged with a late fee, and if you don't pay off your full balance, you will pay interest. Those who can pay off their balance every month can take advantage of points, redeemable in dollars, airline miles, other perks. So I understand why somebody would want to take advantage of that. I think the deck is stacked against most of us in many ways. And if the system is openly encouraging us to use credit cards, and some people will be able to benefit from them, then I'm not going to say not to use them. I think we should all be trying to do things ethically and legally and strategically to get ahead. But for those who know they have a problem using credit cards when they shouldn't be, stop using them.
Yep. To the other side, to using them for what's called broad title manufactured spending, meaning I'm going to spend on my credit cards, I'm going to get the points, I'm going to pay off the credit cards swiftly and with great responsibility. Yeah, it's legit. It also takes a lot of work. It's almost like a part-time job just to shuffle those around. If I pulled up my wallet and showed you my list of what card for what type of merchant, dutifully maintained by Mrs. Levy, each quarter, and now gas goes on the Costco Visa, and this goes on that, and God forbid you come home and you went to Trader Joe's and used the wrong card. So guys, it's a peril, it's a pitfall just to get into this if you can't follow your wife's instructions. But that being said, it's legitimate if you have the means to pay them off. Yeah, you can earn perks that are great. I mean, we've flown all over the world for free. So, what other Dave Ramsey points though would you put in the negative category?
In the negative category, I would say his take on gold. Dave Ramsey calls gold a useless rock with no intrinsic value. And that's not true. Gold has been used as money in different societies all around the world and all time periods throughout history. They didn't necessarily even communicate about this, but time and time again, people decided on gold and silver as money. And that's because it's scarce, easily recognizable, desirable, can be used as jewelry, a key piece of making electronics, is used in space travel, and it's very durable. A piece of gold found thousands of years ago will look the same today. It does not rust, it does not erode. So for Dave Ramsey and anyone else to say gold is useless, has no intrinsic value, you have no business owning it for any reason, I can't trust that person.
So should we go on to the clip?
What, one more? I mean, I guess this is part of the clip, really. Probably. But the only place that he tells people to invest in is mutual funds. It's the only thing. Yeah. It's the only thing he talks about is you should only be investing in the mutual funds that I promote. And correct me if I'm wrong, but as far as equities, like market-based investments go, they're probably the place where you have the least amount of control, the least amount of liquidity, the highest fees, and maybe he thinks that you're too stupid to manage your own investments and to hold them for a long period of time. And what about the average rate of return that he says you're going to get inside of these mutual funds? The holy 12% every single year without fail. He acts as if it's uninterrupted 12%. And he says and it'll average 12%. But an average rate of return and an actual rate of return are two completely different things. And that's a whole topic that we could spend an entire other episode on. I'll just leave you with one quick thought. If you have $100 and it goes up 10%, how much money do you have?
$110.
And then if that $110 goes down 10%, how much money do you have?
That math's too complicated for me with a calculator,
okay.
But...
So 10% of 110 is 11. Mm-hmm. 110 minus 11 is 99. So you've averaged 0 because you went up 10, you went down 10, you averaged 0, and you lost $1. So that's a quick formula of how average rate of return and actual rate of return are two different things. And when losses are involved, averages mean nothing.
Yep. And or at least when we run the clip also.
They mean very little. So that's another thing I'll have in the bad. Promising 12% returns, and of course that's before fees. Of course that's before taxes.
Right. There's no talk of tax treatment here. There's no talk of today when I looked 39.28 trillion in debt. There's no talk of what's going to happen when taxes rise. So there's no strategizing. It's as if today's capital gains tax rate were going to be the capital gains tax forever.
Okay, so again, and right before we get to that, the ugly. We have the good, the bad, and the ugly of Dave Ramsey. The first one that I'll say for the ugly is I don't know if this is something that he's promoted forever, but it's something that I saw in the last couple of years, and I'm assuming this is just his stance, that you can withdraw 8% from your retirement portfolio and still assume that you're going to be good. That means that if someone has $1 million in retirement and they're starting to sell it off each year for income, they can safely withdraw 8% of their balance, which is $80,000 every year. And this is a sure way to run out of money at the time when you need it most.
Yeah, well, that's easy to say 8% if you're telling people they're making 10% or more in their funds every year.
And that's what he says. He says something about, well, if you're making 12 and you want to leave room for inflation, then you can safely withdraw 8. And he just leaves it there and just expects you to follow along with whatever he says because he's Grandpa Dave.
I think industry standards are less than half of that, actually. From
industry
CFPs
standards are 4, is what the going wisdom has been for the last 30, 40 years. And some are even revising that down. I think I've seen Dr. Wade Pfau say people should consider only withdrawing 2.8% from the equity side, the stocks side. Okay, and the main event, where we actually come into play here, because you could see a lot of people talk about Dave Ramsey, and they'll say a lot of these things, but we're gonna go through a clip where he is talking to somebody who purchased a whole life policy, and this person references infinite banking, and as we watch the video, it's very clear that this person does not even understand what the infinite banking concept is. Who knows if he knows the name Nelson Nash? Who knows if he's using the right type of policy structured the way we would? It doesn't matter. The more interesting part is how Dave responds to the caller.
All right, we'll go to that clip from the Dave Ramsey show and see if we can break this down.
With us in Nashville. Hey, Jim, welcome to the Ramsey Show. How can we help?
Hey, Dave. Glad to talk to you.
You too, man.
Enjoy your show.
Thank you.
All right. I am calling in response to a video I saw recently that you claimed infinite banking concept was a scam and actually got quite pissed off about it. So I do not agree with that in certain points that you made in that video. And I have set up a policy for my son when he was 1 year old. He's 5 now.
I'm sorry.
Say that again?
I said I'm sorry.
Yeah, so am I sometimes. No. So I set that policy up for him when he was 1 year old. It has a $500,000 base value. We pay $5,373 a year for 13 years, and it's paid up at that point.
Can you pause right there? So right away, if somebody's coming out and talking about how they have an IBC style policy, and the first thing you bring up is the face amount, like, who cares? Sure, the death benefit matters. Of course it matters, but that's not the focus here. It's just interesting to me that that's how he would lead. And then, yeah, he does say that he's paying upwards of $5,000 a year. But, like, why isn't he leading with the reason that he did this in the first place?
Right. In a deeper level, when my son is 20 years old and needs to buy his first car, he can finance it with his own cash value and not use someone else's banking system. So,
Yeah,
very
and
good point.
that ties into the later part of the video. Carry on.
Yep.
Discuss that I just didn't agree with.
Okay.
Do you want to just kind of take one thing at a time?
Sure, that's fine. Sure.
Okay. One of the main things was that you claim that the cash value dies with you, and you only get the face value paid out.
That's true.
That is, well, it's not true if you reinvest the dividends back into the policy.
Dividend reinvestment is not cash value. Dividend reinvestment is because you have a mutual company and the policyholders are the owners of the company. And so the profits from the company come to the policyholder and they use that to buy paid up additions. That is not the same as keeping your cash value. That's buying extra insurance with your overpayment.
But it still works out to be
No.
having a cash value much greater than the 69,000.
All right, so there's a few things to break down here, and it gets a little deep. So two things, talking about how at death the insurance company keeps your cash value. Let's start on that topic. So that economically speaking doesn't make any sense, because the death benefit is the asset and the cash value is the equity that you're building up in the asset. They're technically one and the same. Cash value is just equity that you have control over, that you can leverage. The death benefit is a guaranteed future payment. Because it's a guaranteed future payment, it has a guaranteed future value. That means it has a current present value. It has to. That current present value is equity, and it is called cash value. So they're technically the same thing. If a day before you died, you borrowed out all the cash value, then of course you're not going to get both the cash value and the death benefit. There's a lien against the cash value portion of the death benefit.
If you took a large policy loan, if you leverage the cash value, it'd be akin to maxing out a HELOC and then selling the house and expecting the full value of the house. No, you would have to pay back your creditor, the bank, the amount of proceeds from the sale that are underneath or that are owed to that HELOC.
Yeah,
so
that's a perfect
Dave Ramsey
example.
conflates these all the time. And he does it just to cast a shadow on life insurance. I don't know if it's because he doesn't understand, but or maybe because people are, maybe if someone's defending life insurance as a good investment, which legally it's not, product-wise it's not, he's saying, okay, if you're going to call this an investment, then I'm going to call your cash value your asset, and the death benefit something else, something that my guys are going to obtain through renting insurance via term insurance. So then he's attacking on that level. But
it's not two separate things. It's not like you bought a life insurance policy and you have a side account that's a savings account. It's not that at all. They're one and the same.
It's the cash value of a policy is the amount of money that you have access to while alive. The death benefit is what's paid at death. The death benefit will always be larger unless you live to age 120, when they do equate. So you outlive 120, they give you a check for your full death benefit because you realized the entire cash value as equity. But,
so then he was also saying that dividend reinvestment, PUAs, are not the same as cash value. And they are. Technically speaking, they are. Because when we pay PUAs, a PUA, as he'll say, as Dave Ramsey will correctly say, a PUA is you're purchasing additional paid up insurance. So when you're buying paid up additional insurance, your dollar for dollar that you're paying in PUA premium, you now have access to as cash value.
Yep.
So dividend reinvestment does increase your cash value. 100% it does.
Let's
All
go
right.
forward in this.
Let's go forward.
$849 we put into it.
But the actual
Right.
cash value, not the paid up additions, the actual cash value dies with you.
No, because
Yes, it does.
Okay, but your death benefit is larger than your cash value. So for me, I looked at it
Because
as
you bought more
generation-
insurance. You know what a paid up
Yeah.
addition is? A paid up addition is buying additional insurance.
I understand
That's why you're
that.
getting more at death. Not because you
Right.
got your cash value, but because you used your policy dividends to buy additional insurance.
He's ignoring willfully or out of ignorance that paid up addition purchases become liquid. They become liquid inside your cash value. Instead, he's saying, no, you're not going to benefit from that until you're, right here. He's doggedly saying you're not going to benefit from that until you're dead, which is not the truth.
Mm-hmm.
Right, but
That's different than getting your cash value. If you took those policy dividends and went and bought a term insurance policy for $100,000, well, you'd get $100,000, but that's not your cash value.
Well, I have a term policy.
I
Me and my
know,
wife have
but
term
you missed my
policy.
point. Okay, you're talking about you use the policy dividends, you use the money they send to you because you're in a mutual company to buy additional insurance.
Yes, paid up additions, yeah.
Yeah. If you buy a term policy on the side for $100,000 instead with that same money, you would get $100,000 more than your face value, but that's not your cash value. That's additional insurance. They're different.
Right, they are different. In term, you don't have cash value to borrow against.
I'm aware of that, but your point was that you don't lose the cash value, and my point is 100% of the time, by definition, you lose the cash value.
Okay, so
Ready to join the booming cruise industry? Become an
did
Expedia
not see
Cruises
that.
franchisee. You'll be part of the Expedia brand with its global reach and reputation, and with your own brick and
Yeah,
mortar neighborhood
we
location.
haven't been commenting for the
As I
last
said, tit
minute
for
or so,
tat. If
because
you
we kind of covered all this already.
supposed to be 80. I'm looking at the readout here. If say he only lives to be 80, okay?
All right.
The cash value will be worth about $2 million, but the payout for the death benefit will be $2.6 million. So, okay, technically, yes.
So you
you're
take
right.
the cash,
value
you're taking your policy dividends and go buy term insurance with it, and you would have more than you're talking about because you're getting with this rip-off whole life crap.
Yes, you would get a high, but you wouldn't be able to use it throughout your life as your own bank.
Well,
I think that's
okay. But here's the thing:
the big thing
that's a
missing.
side issue. That's a side issue. But your first issue was, he's going to have all this money at retirement. Well, let's just do a little present value calculation on what you put in for a baby. $5,000 a year for 13 years. Do you know what that would be in a mutual fund? At age 88, it would be $25 million, dude.
He's going to have that anyway.
No, instead of putting it into this rip-off thing and making...
So I haven't done the math on $5,000 a year for 13 years and just letting that ride. $25 million? Good luck with that. Maybe those numbers work out when you're assuming 12% every year for 80 years. But the way he's saying that is like, well, even then you're still going to... $25 million at 88. You're not touching it for 88 years. So, okay, great. You have $25 million at 88 and you haven't been able to touch it your whole life?
I'm actually trying to ask the question this here. Google. Conservative 7% return, 1.7 million. Moderate 9% rate of return, 6.2 million. An aggressive 11% return. Now we know where Dave's getting at. 22 million. But one thing that we talked about. Hold on. What is the combined death tax rate? Estates over 15 million. So estates over 15 million are going to be hit with an 18% death tax. So he's ignoring the tax implications of this, meaning to say, once current administration, current rules, congressional IRS rules, your estate as a married couple goes above 15 million, You're taxed at 18% of whatever the dead person is trying to leave over. So
And that's
go pay
only
that
right
18%.
now. I think when Bush Bush Jr. was in office, the estate taxes was for anything over like 500K. I could be wrong about that exact number.
No, there were times when it was
a lot lower. Or maybe it was
there were
Clinton.
times when it was as high as 20 million as a combined minimum. But the
Right.
point
So right
is,
now Trump has it at higher. But the point is that can always change.
can always change, especially as the debt grows more and more critical. And the debt today, last time I checked, it was a whole hour ago, so it's probably a lot higher now. No pun intended. Was 39.28 trillion. So
Yeah. And when this guy, when Jim in Nashville, Tennessee is saying, well, he can have both. I don't know if he doesn't really go deeper on what that means. I don't know if he knows how true that is, but he can have both because he's building equity in these policies. His father could be borrowing against his policies and making investments. And if those investments happen to be mutual funds, then fine. Hopefully they do well for him.
yeah, hopefully they do
But
11%.
that's the point here, is that you can have both.
Right. Let's go a little forward.
Dies, he loses his cash value. If you had put this in a good mutual fund, you'd have 100x, 10x the amount of money, and that's your infinite freaking bank.
But we're only putting in 70,000, and he's going to be.
That's how present value formula works in finance. Look, let me just take the same.
I mean, I understand.
Let's intellectually deal with this for a second, okay? Take the same amount of money when you get off the air and put it in a financial calculator at 11% and pretend it was invested in mutual funds and see what it is when he's 88 years old.
It'll be more.
A whole lot more.
And he'll have that too. With this, to me, is a way to.
No, he doesn't have that too.
To borrow against.
That's called opportunity cost on your money. You put it into something that's going to make him at 88 have $2.5 million, and he should have had $25 million because you screwed up and put it in the wrong thing.
Well, when we screwed up and put it in real estate too, he's going to get real estate.
Well, then put the money in real estate, but don't put it in this crap.
I have to respectfully disagree.
Well, on what basis? He's getting more money if you put it somewhere else.
But he's able to borrow against this.
Hey, if you've got $25 million in mutual funds, you can borrow against it.
Which I'm sure you can. I don't know how that would work in mutual funds, but I'm sure at some point you can borrow against it. Of course, it's not going to be the same type of loan as a whole life policy loan. Good luck skipping a payment on a loan against any stock deal.
Liberally, between 50 to 70% of current equity value. So on that $25 million, as an 88-year-old now, that means what's it going to be as a 40-year-old, significantly less. And what can he borrow as a maximum? I mean, liberally speaking, 50 to 70%. And what does he owe? Well, that'll be up to the bank, and that'll owe to the mutual fund company. That'll be up to the current lending market rates. That'll be up to his credit. That'll be up to the institution that's enforcing those repayments, which is a completely different thing than owning your own debt inside of an
That'll be
bank.
up to the performance of that mutual fund or that portfolio in the first place. Because if it drops below a certain threshold, then
is he trying to borrow?
Loan.
Beautiful. Is he trying to? He has $100 million. Well, what did he have in 2009? Well, about $50 million. And what will he have? So-called today, when the stock market's flirting with 50,000, the Dow Jones, and you think you're on top of the world, and you think that's the baseline forever. That's the new bedrock is 50,000, as if. So anyone that has their positions in the market today. Then when, not if, when a correction comes, how much do you have in the market then? And then how much can you borrow from it? And then what's the top line percentage of your equity that the mutual fund company is going to let you borrow from that reduced amount of equity when the market corrects? I mean, good luck. He's completely ignoring timing in this of the market. as you alluded to earlier, is it an average rate of return, or is he accounting also for the ups and downs of the market? He's clearly saying, as if you're going to earn 11% in perpetuity till you're 88 years old. Dude! Had to throw that one in there.
What's the dude for? Oh, because he's calling him.
That's what Dave Ramsey said. You can have $25 million, dude.
Yeah.
All right.
Okay, let's finish this thing off.
But he's going to have to wait until he's retired to get that amount of money.
Okay, so you're going to teach him that the way he becomes wealthy is borrowing against money that his father invested for him. That's how he builds wealth. Said no one rich ever.
Said no one rich ever. Go look at the Rockefellers.
No, they do not. You've been watching too much TikTok. Banks do not use whole life.
Pause it right now. All right, that's my favorite line. Banks do not buy whole life. Not ever. I guess you could have continued it because he's going to say they wouldn't allow to buy that crap. That wouldn't be legal. Everyone, if you're watching, go Google bank-owned life insurance. Banks own life insurance. They do buy different types, not necessarily IBC style.
Right.
But that's besides the point. Life insurance on a bank's balance sheet is classified as Tier 1 capital. It's treated as cash.
Yeah, this was the most astounding. I mean, this is ignorance, willful ignorance, or that's a lie or willful ignorance.
I have to say it has to be a lie. Can't be willful ignorance.
Yeah, you got to read.
He spent the last 30 years in finance. Surely someone's told him, by the way, banks own life insurance. Right. He's like, yeah, but people aren't looking at banks' balance sheets. They're just listening to me on the radio.
Right. Do you know what nerd, God bless him, looks at bank balance sheets? Barry James Dyke. That's who. You have to read the Pirates of Manhattan, the whole series. In the first one, and that was early 2000s, he gets, there's like 300 billion plus in bank assets owned in life insurance.
And that was written did you just say it was written in the early 2000s?
Early 2000s, yeah.
Banks own hundreds of billions of life insurance.
No, I'm saying they did then. I'm sure it's closer to $1 trillion or more now. It got zero coverage until Barry James Dyke. And his work in uncovering bank-owned life insurance, he was the first one. So
yeah, and of course they do it for different reasons than we're doing it as like controlling the banking function in our lives. They're doing it to fund executive bonus plans, executive compensations, different types of pension planning, and when that bank executive passes away, then it replenishes because the bank owns that policy.
Yeah.
We don't need to get so into bank-owned life insurance. Just to say that is a bold-faced lie.
Yeah, in that book, there's bank literally presidents quoting it. That's our best performing asset, and that was that was pre-2008. That was pre-Great Recession. That book, meaning when everyone thought the market was hunky dory, right? Party time again. Break out the sparklers. The economy's awesome, i.e., right before the crash of 2008. That's when bank executives were quoted by Barry James Dyke saying, "This is our best performing asset, our life insurance." So, my goodness.
Pretty sure he says a couple other dumb things on the topic. Let's continue.
No banks sell.
I would respectfully disagree.
No,
with
they
that.
don't. They do not use whole life insurance.
What bank?
Well, we could Google it and see what typically banks do with their money, but I believe
typically banks never put money. Let me tell you what banks do. They put it in bonds. They're required to. They wouldn't be allowed by federal regulations to put it in whole life.
They wouldn't be allowed. What do you think life insurance companies' primary asset is? Bonds, corporate and treasury bonds. Life insurance companies own hundreds of billions of dollars. Depending on the company, maybe tens of billions of dollars of bonds. So that's your main.
It's not a place to.
Go ahead.
No, continue.
All right.
Invest money because it's a horrible investment. The rate of return sucks, and when you die, you lose your cash value.
I know, but you also you're making it sound like I'm losing money on the whole.
You are. You're leaving money on the table.
You're making it sound like. you're making it sound like when, not me, but my son, when he dies, that he's only going to be able to get
He's going to have $22 million less than he should have if you had put this in a good investment.
Well, he's just treating it as if it's like a savings account that you just leave there.
The caller, Jim from Nashville, is not really able to argue the side of infinite banking either. In this case, Dave and his cohort, they're able to walk all over him. Notice she got her 2 cents in. Which bank? You're leaving it on the table. There's ignorance on both sides of this debate, but the willful ignorance or lying is coming from Dave's side.
Mention that the cash value dies and you only get the face value. That's
Correct.
Not true.
That is true.
That's not.
I just covered that with you for the last 10 minutes. Paid up additions are the only way that cash value increases unless you're using a universal life program B where you pay extra to get the extra insurance, which is another form of paid up additions.
That isn't coming out of my pocket, though. I put $70,000.
It is coming out of your pocket.
It's coming out of the policy's pocket.
I know. The policy, you put the money in, dude, and then it paid you a dividend, and you chose to buy more of this crap with the dividend, and you're calling that I kept my cash value. No, you didn't. You bought more insurance.
I think what he's saying is right about the function of the policy, just obviously not the way he describes that you bought more of this crap. Buying paid-up additions with your dividend is the best thing to do with your dividend.
Right. It's increasing your dividend exponentially as the life of the policy goes on. And again, he's conflating with every breath. Cash value is separate from death benefit, meaning, cash value is the amount of the death benefit, the equity that you're able to access while alive, and death benefit is what you're paid out after death. By this time, the debate gets very hard to
watch.
Descending into madness over here.
Let's just finish it.
Cap it off here.
70,000, and at a certain age, it's going to be at age when he's 15 years old. That's going to be paid up.
Yeah, Jim, you understand what paid up is? You understand if you're alive that there's a probability of your death. And so 100% of the time that a life insurance program is paid up, it means that you prepaid it. That's all it means. Because as long as there's a probability of death, there's a cost. So the insurance company has always got a cost as long as you're alive. So there is no such thing as a paid up. That's an industry term that gets suckers like you. That's what it is. No, paid up means prepaid. You paid all of the premiums in 13 years for his whole freaking life in advance. That's why it's paid up.
Saddest part is that he only paid premiums for 13 years. Look at how efficient a 13-year-old policy is. The first dollar you get in your life should be to continue on in that policy. Why are you stopping after only 13 years?
Just so everybody knows, paid up means each flavor or design of a policy has a maximum amount of premiums that can be paid into it. And so you'll hear regular whole life 100 where, yes, premiums can be paid, do not need to be paid, all the way up until age 100. There are many, many plans that are pay up until age 65. It's meant to track with a life cycle. I mean, if you're going to be working until 65, you're going to put your money somewhere. Where you're going to put it? Okay, you can put it in life insurance as a premium payment. But paying up at age 13 of a child means you've paid in enough, and by the way, really a minimum of life insurance, so that it's as if you've paid up all that you need to keep that policy healthy and growing throughout the child's entire life.
So paid up means the policy is fully paid up. It won't accept any more cash.
Correct. And yet, what you referenced or what you alluded to was, if this were truly designed as an infinite banking policy, that child at 13 would be like my kids, hacking stuff on eBay or fixing kids' bicycles, making an income. Where are you going to put your income? You're going to put it in your 0.05. I have a child who just turned 18. They sent me a whole packet from the bank. Hey, did you know that now he's eligible for one of our adult checking accounts? I'm looking at the rates. For under $25,000 in the bank, 0.05%. So if anyone remembers my story of back in on our Real Change Financial page, of keeping 86,000 in the bank when they were paying me 0.04%, I could say, Mazel tov, kid, you're making 0.01% more than I did. The banks have really come around in the last 10 years, 15 years. But the kid should want to be able to graduate, get a job, and put his money in that very same policy, because a mature policy is an incredible place to put money. And here's the father who has sold something with I and a B and a C on it somewhere on the illustration saying this is IBC, but now the kid is capped at age 13 and can't pay any more money into this. Not
Just
really
to
the way to
clarify,
go. But
I don't think there was any IBC on the illustration. IBC is just a concept. You can't call an insurance company and say, I want an IBC policy. Like, that's not a thing.
You could, to judge him favorably, there are limitations when designing life insurance in a child. So it could be that he really is, this gets a little technical, putting in as much as he can, and then to prevent that life insurance from losing its tax-free status at a certain age, they illustrated stopping premiums. Probably too technical for today, but
Makes sense. I don't think a child can have more death benefit on them than the parents do.
well, in most cases they're limited to half of what the parent does. So the parent probably has $1 million, and they reverse engineered it. We do it all the time. Sure. But the concept of calling it IBC, in the name of Nelson Nash, it is not, because we wouldn't design a policy where a child is done, can't put any more in. We'd want them to be able to pay throughout their life when that policy is getting more and more mature, and the actual year-to-year rate of return is off the charts. Really interesting discussion. I mean, Dave Ramsey he's like a perfect Nelson Nash, to quote. I better turn to my own book. Will Rogers. I don't have to. It came to me first. To quote Will Rogers, he knows so much that just ain't so. Dave Ramsey about whole life insurance.
The problem in America isn't so much what people know, it's what they think they know that just ain't so.
That's right. Exactly.
Yeah, and that was said what? That was said, I mean, that's an old quote. That was said 100 years ago? How much?
At least
80 years
50s,
ago?
I think.
I think it was before then, but besides the point. How much more so is that true today?
Yeah. In the age when you can, the lie will go around the world 5 times before the truth gets its boots on, right?
Especially in the information age, where so much information is just a click away. The real problem isn't so much that the information is there, is that people have no attention span. For those of you who have made it this far in this video, I mean, thank you, and that's amazing, because most people are probably gonna swipe or find something else that looks new and shiny 45 seconds in.
Right. That's a testament. Tell you what, don't tune into the next episode. Don't click any of the references or look at our description if you don't like interviewing for an hour to learn more about infinite banking and to build the case for you for what a personalized life insurance plan would look like. Because it's nothing that can be done in the back of a postcard. It takes a lot of education and time to get it right, and then revising and reviewing and changing in many cases. Well, what if we put more premium? Why do you have my ability to pay premiums ending at age 13? How about age 80? Wouldn't that be better? And it just takes a lot more planning than
it does take some understanding and planning, but it's not like you have to understand every little detail of how these policies in the life insurance industry in general work to get started. As long as people understand that this is a great place to save money when you compare it with a savings account, because this is not an investment, this is a savings vehicle. And once you have that money saved, it's going to be the best place to use that money to pay down debt, finance major purchases, and fund investments. And once you do that, you will own this line of credit. You basically own the debt. As I referred to earlier, that's what Nelson Nash realized, that he can take control of the banking function by owning his debt. And once you do that, you're setting yourself up for a really nice asset in retirement.
Absolutely. So, listen, we are not the first to pick apart Dave Ramsey, but happy to jump on this train because there are some just intellectual fallacies that really need addressing. Hope you guys like the episode.
Absolutely. Thank you guys so much for joining. Thank you, Penny. Always appreciate your time and your insights. You're a very wise man.
Writing my obituary. Beautiful. Good thing I have a lot of life insurance.
Thank you for listening to Go Bank Yourself. To learn how to apply these strategies in your own life, email Dovi Herman at realchangefinancial.com. We'll see you in the next episode.